Hello everyone, I am Rakshita S. from first year MCom, second semesters, Department of PG Studies in Commerce, Government First Grade College of Art, Science and Commerce Sira. Subject Advanced Financial Management. My topic is Credit Risk Management in Financial Institutions. Introductions of credit risk. The possibility of a losses resulting from a borrower's failure to repay a loan or meet contractual obligations. Credit risk management meaning. Credit risk management is the practice of mitigating losses by assessing borrowers' credit risk, including payment behavior and offerability. Scope of financial risk management. The course helps students understand corporate finance, risk management, compliance, finance, capital markets, valuation and equity research. Types of risk financial institutions. First point, liquidity risk management. Banks must safeguard long-term assets, funding, use long-term liabilities. Then second point, interest rate risk management. Interest rate risk management is the exposure of an institution's financial condition to adverse movements in interest rates. Third point, market risk management. Market risk is generally defined as the risk of the mark-to-market value portfolio instrument or investment increasing or decreasing as a result of volatility and unpredicted movement in market valuations. Then fourth point, credit risk management. Credit risk management is the practice of mitigating losses by assessing borrowers' credit risk, including payment behavior and offerability. Then fifth point, operational risk management. Operational risk management attempts to reduce risk through the linear process of risk identification, risk assessment, measurement and mitigation, monitoring and reporting while determining who manage operational risk. Sixth point, model risk. Model risk is a type of risk that occurs when a financial model is used to measure quantitative information such as a firm's market risk or valued transactions, and the model failure or performs inadequately and leads to adverse outcomes for the firm. Then seventh point, ESG, environmental, social and governance risk. Environmental, social and governance risk are those arising from environmental, social and governance factors that a company must address and manage. Sources of credit risk: financial institutions, loans and certain type of balance sheet items such as letters of credit, lines of credit and unfunded commitments. Fundamentals of credit risk management. First point, credit worthiness assessment. Credit worthiness is a lender's appraisal of how likely you are to repay your debts. Then second point, evaluate data sources. Evaluating data and statistics. Critically evaluating statistics requires a thorough examination of its reliability, relevance and validity. Third point, portfolio management. Portfolio management is the selection, prioritization and control of an organization's programs and objects in line with its strategic objectives and capacity to deliver. Fourth point, setting credit limits. Based on this assessment, the supplier set a credit limit, which is the maximum amount of credit they will extend to that customer. Fifth point, credit scoring. Credit scoring is a statistical analysis performed by lenders and financial institutions to determine the credit worthiness of a person or small owner operated business. Sixth point, regulatory compliance. Regulatory compliance is an organization's adherence to laws, regulations, guidelines and specifications relevant to its business process. Credit risk mitigation techniques of a financial institutions. First point, enterprises-wide implementation of standard credit policies. Credit policies is a firm-specific framework designed by management to standardize lending decisions in accordance with the firm's risk appetite. Second point, efficient credit data aggregation. Efficient data aggregation. Data aggregation is the process of collecting data and presenting it in a summarized manner. Third point, standardized approval workflows. An approval workflow rotates a document or other items to one or more people for approval or rejection. Fourth point, best in class credit scoring model. Credit scoring model is a mathematical algorithm that uses various factors to assess the credit worthiness of a borrower. Fifth point, periodic credit review. Once the loan is granted, lenders conduct periodic reviews to monitor repayment patterns and assess continued credit worthinesses. Conclusion. The aim of credit risk management is to maximize a bank's risk adjusted rate of return by maintaining credit risk exposure within acceptable parameters. Thank you.